Good evening, everybody, and welcome to this month's edition of the Monthly Market Equity webinar. As usual, we hope to be able to cover some topics which would be of interest to you. And the idea is to provide you with some insights into some of the broader features and macro parameters, valuations, etc., of the marketplace. And this month, I have two of my colleagues joining me on this webinar. Swati Kulkarni, whom all of you know very well, who has been helming Mastershare now for over 15 years. And I'm delighted to also have today on this webinar Karthikraj, who joined us very recently as a fund manager from BNB Baroda Asset Management, and he brings a rich track record and experience with him from the firm I mentioned, as well as ICICI Prudential before that. So we're going to have both of them joining us on this call today. As regards the format, as usual, I'll kick off with the initial presentation for about 10 to 12 minutes, and I'll request my colleague Niranjan, as usual, to play host, and he'll be pulling up the webinar on the screen. And please keep sending in your questions. I'm delighted to see that we've already received quite a few questions for this session. So we'll try and take them in the course of the webinar, as well as you can continue to send in questions to us, and we will take them right at the end. So without any further ado, I'll request my colleague Niranjan to bring up the presentation on the screen. Hopefully it's now visible to all of you. So that's going to be the lineup in today's call. So moving on from there to what we are going to discuss first, discuss some parameters on macros, on fund flows, and then finally also as regards the valuation parameters. So diving straight into the next slide, I'm sure all of you saw the news recently in the past week. It's been all over the financial media that India has now overtaken UK as the fifth largest economy in the world. Now, obviously, that is a great piece of information if you're an Indian. And on this slide, you can see the progress that India has consistently made over time, not within the top 10 economies prior in 2000. Then it debuts within the top 10 in 2010 and continuously keeps moving up. In 2021, it's the sixth largest economy, but data which has just come out suggests that we have now moved up to the fifth spot. So little over $3 trillion economy. The other interesting part is on the right-hand side slide. As you can see, for many years now, the key global economy has actually been China. When you look at incremental growth, which happens in the global economy every year, the largest contribution to growth has actually been coming from China. But what's increasingly visible is that the economy which is likely to make the most dominant contribution to global growth after China is now going to be India. And as you see in forecasts over there, as you move further out into the future, in fact, it will be India which will have the biggest delta in terms of its contribution to global GDP. So clearly, this is something we should all take great pride in, that the country, when measured by GDP, has increased its ranking within the league tables. Moving on to the next slide, this is a slightly different perspective I wanted to give because I think it's also important to keep this in mind, which is really the year in which each of these countries has actually hit approximately the $3 trillion GDP mark. In which year did it happen? So you can see over there, Japan 1988, United States 1981, United Kingdom and China both in 2007, along with Germany, and India in 2021. What you've also got is the number of listed companies, and you've got the per capita income in the year in which the GDP has actually crossed $3 trillion. And you can see that we appear to be exactly about 14 years behind China. So when China became a $3 trillion economy in 2007, it had a per capita income of $2,000. And today, when India has become a $3 trillion economy, it has a per capita income of $2,200. The other point that I would make here is, as much as it should give us pride and satisfaction that when measured in terms of aggregate GDP, our GDP is now $3 trillion, what really matters to the individuals of the country is their per capita income. And that is where India still qualifies as being a low income country with a per capita income of $2,200. And there is a long way that we have to go to really lift our citizens into middle income territory, which will be in the region of about $10,000 to $12,000 per capita. And by the way, if you look at some of the large metropolitan cities of India, like Bangalore and Mumbai, their per capita income, when calculated for the region, that small region, is in that range of $10,000 to $12,000 at this point of time. So that's the kind of distance that we need to go in terms of lifting individual incomes in this country. Moving on to the next slide, I've also seen a lot of conversation about how moving to the 3 trillion mark can have significant ramifications in terms of market capitalization. And what we've shown over here is, for that same set of 5 countries, how did nominal GDP behave between the year in which they became a $3 trillion economy and their current GDP. And alongside, there's another set of bars which shows you the behavior of market cap during that same period. So in the case of Japan, for example, we can see the nominal GDP of 1988 and the nominal GDP of 2021. And similarly, you can see the numbers for its market cap. Now, the interesting thing to note over here is there is no such relationship of a breakaway movement in market cap related to increase in GDP. As the chart shows you, over a nearly 30-year period, Japan's nominal GDP went up 1.6 times. The total market cap went up about 1.7 times. Now, the most stark ratio here, of course, is the United States, where from 1981 to 2021, a 40-year period, nominal GDP went up 7 times, but total market cap went up 42 times. And in the case of United Kingdom, actually, in the 14 years since they became a $3 trillion economy, market cap has actually gone down. So the simple point I would make when you look at all these numbers there, including China at the bottom, there is no consistent relationship between the behavior of market cap and the behavior of GDP. Why? Because market cap is a function of the kind of businesses which get created in the country, the kind of earnings that they generate, the return on capital that they generate, and the quality of entrepreneurs that you get in the country. And that is an enabling situation for that is a growing economy, but it is not a sufficient condition. I should also add over here that growth in market cap does not equal growth in the actual, or rather the increase in the index over that period, because growth in market cap can also be created by new listings. So, for example, if you take current US market cap as of 2021, the top 4 of the top 5 companies, which make up the highest market cap companies in the US, actually had negligible market cap or were not even listed in 1981. Think of names like Amazon, Facebook. They didn't even exist and they hadn't even been listed at that point of time. So market cap creation is a function of how entrepreneurs and businesses get created and not necessarily a pure derivation from GDP. So once again, there's a fantastic enabling condition, because a $3 trillion economy which is growing is very conducive for strong businesses to be created, driven by a large capital pool availability, the supply of good entrepreneurs, but only few economies have managed to convert it into outstanding market cap generation. And obviously, we would hope that the Indian story would look something closer, or at least would aspire to look like what has happened in the United States. But it is something to remember that the United States is the exception to the rule and not necessarily the outcome, which is guaranteed to every country, as this data indicates. Moving on from there to the next slide. I think one of the things which should also give us a lot of satisfaction, though I see a lot of disappointment when I talk to investors, is that, the market over the last 1 year has not really done too much. It's sort of flat on a 1 year basis, up maybe 2 to 3%. But of course, if you were to pull the data series all the way back to December of 20, then what you see is that the Indian market has actually been an outstanding performer compared to any other series that we see here. China, which is the yellow line, has been a complete disaster, down 40% over this period, while India is up 30%. And if you look at the MSCI World Index, which is, of course, dominated by the US, which has nearly a 2/3 weightage in the MSCI World Index, it is unchanged over this 2-year period. So the story of this really is that we should not be disappointed in the absolute performance of the Indian market, because in some senses it reflects the challenges posed by high valuations we had a year ago. But what we are also missing out is that given our stronger macroeconomic situation, it is reflected in the relative performance that India has generated relative to other markets, both world and emerging markets. And that is what is the story of this slide. Moving on to the next chart I wanted to share with you today. This is the chart of the dollar index, the DXY as it's known. And I'm sure all of you have read a lot about this recently, about the record strength of the DXY. This is pretty much the highest that we've seen for the DXY in almost 7 or 8 years. And there have been significant concerns about a collapse in the value of all currencies, including that of the rupee. But what if I told you the rise of the DXY is really a story of the collapse in some of the other developed currencies and not in emerging market currencies like the rupee? You can see this on the next slide, where we have plotted the performance of various currencies, or rather of the Indian rupee vis-a-vis major currencies on a year-to-date basis. Now, what this shows you is that no doubt in the face of the strength of King Dollar, the Indian rupee has wilted by 7% year to date, but there has been a free fall in most other developed currencies, starting with the Japanese yen, the pound sterling, the euro, and even to some extent the Chinese yuan. So in effect, the green bars indicate that while the rupee has fallen against the dollar, it has appreciated by 15% against the yen, 9% against the sterling, 5.5% against the euro, and 2% against the yuan. Relatively unchanged against the Swiss franc, which is seen as one of the other global strong currencies, and down about 4% against the Canadian dollar, which is also benefited from strong trends in commodity and oil prices. So while we may worry about the weakness of the rupee against the dollar, I think what we should keep in mind that when you consider India's purchasing power parity against a basket of currencies, because remember, our trade happens with multiple economies, and those economies eventually have their own currencies against which those trade would eventually get converted, then in effect, our currency is maybe depreciating against the dollar, but in effect, it has appreciated against most other currencies. And the reason for this is what I mentioned earlier, which is India's macroeconomic situation seems to be in a far better situation, and that is why we are in this particular outcome where we've actually done very well relative to other global currencies. So moving on from this section, I'll just jump straight to the valuation slide now, and we'll just move to the Nifty 50 valuation slide, and that will come up in the next. Yeah, you can see that over here. Yeah, if you just move to the next slide. Yeah. So you can see over here the Nifty trailing 50 and the Nifty 50 forward P multiple, and the trailing P trading in fair value, somewhere between average and +1 standard deviation. The forward P has gone back into slightly the expensive zone. But if you move to the next slide, which shows you the price to book, then we still appear to be trading somewhere in the comfort zone, but above the long-term average. So, broadly speaking, I think we would continue to say that valuations in India, the trough level actually happened in May, June 22, the recent trough, but from that level, level we have bounced, but we are still not very expensive. We are still somewhere in the comfort zone, but increasingly we are coming near the top end of the comfort zone, which means as much as our macroeconomic situation is comfortable, we should start to worry that any further move in the market actually might start to make it vulnerable from a valuation point of view. So just moving on to the final slide I have today, which is sort of summary of everything that I wanted to sort of summarize, and we can come back to some of these slides later if there's any conversation about them, but we just go to the summary slide now. So this is really the key takeaway. I think there are fears about US growth as the Fed is hiking rates to counter inflation. And in some senses, it's very likely that the Fed at this point of time believes that a mild recession may be the best way to address the imbalances that they are currently facing. Europe and China both struggling for their own reasons. India inflation outside the comfort zone, rate hikes likely to continue. We think the repo rate might rise to 6.25 zone, but still not as far away from sort of the overall comfort zone indicators as it is in some other geographies. High frequency data in India is trading well. Capacity utilization is well above the long-term average. There is some direct risk to growth and earnings in sectors which are sensitive to global growth and from second-order effects in other sectors, which is to say some sectors will get affected first because they have more of a global footprint. But once they get impacted, there will be second-order impact on sectors which do business with them. So we have to be slightly concerned about a downdraft coming from there. Large cap valuations in the comfort zone, but nearing the upper end of that area. So that's about sort of a summary of where we are on the global macro at this point of time. I'm going to halt my sort of part of the conversation today and then hand over to first Swati and Karthik. And as I mentioned again, Swati has helmed UTI Mastershare, which is our large cap strategy for over 15 years now with a fantastic track record. Some of you may be aware she won an award last year for stewarding this fund. But we've made plans for the transition. So Karthikraj joined us earlier this year. So he's had some time to establish, himself with the team, get familiar with our processes, and finally go through a handholding process along with Swati so that we'll be well prepared for the transition by the end of November. So I'll hand over to Swati as she begins to talk about UTI Mastershare.
Thank you, Vetri. Thank you for the market insights and sharing the good news of India reaching fifth position with increasing salience to the world's incremental GDP. Good evening all. As Vetri said, me and Karthik will be covering the next 15 minutes our thought process on the how we have been managing. So typically, UTI Mastershare Unit Scheme is a large cap fund, as you know. And when you talk about large caps, what importantly we realize is that these are all resilient business models, strong financials, low debt, ability to attract and retain talent, and the management bandwidth and economies of scale. All this leads to a good market share for these companies, and large caps typically come with a lower volatility than the rest of the pack. But then you would ask the question, and often we get this question, is that do we find multi-baggers in large cap? And we have done some studies to indicate, and Niranjan, if you could share the next slide, is that when you look at large caps, particularly these names that you appear, these are very familiar names, for example. And what we have done is the BSE Sensex companies from 2005, how they have performed over last 17 years. And here you will say that almost 80% of the companies have generated more than 9% CAGR return out of the Sensex 30 companies of 2005. Now, this is a significant feat, I would say, because, as an Indian, we are used to an inflation which is on an average about 7 to 8% in past. Gone are the days, in fact, it used to cross even 9%. But on an average, if you see last 17 years, the inflation has been in the range of 7%. And the 80% of the Sensex companies have given more return, real return, than the inflation when you consider 9% as a benchmark. So clearly, the multi-baggers are also found in large caps. And typically, what happens is that the sustainable advantages that these companies enjoy, they enable these companies to grow and compound the earnings, and that is what translates into return to the shareholders. The next slide also includes what has been the performance in last 5 years. So typically, if you look at even last 5 years, the multi-bagger returns have been there across the sectors. Of course, few companies, but nonetheless, more than 50% of the companies, even on a 5-year basis, generated more than 9% CAGR. Then the next question which comes to us is that then isn't it easy to just hold some blue chip stocks? And then why do we have to take a route of management of large cap fund or investing through large caps? So to that extent, the same Sensex companies, and we have the next slide, which tells you that you need a standard investment process to find out which are the companies that could that could generate returns over a period sustainably. What are the reasons or what are the catalysts that would enable them? And also, we need to avoid certain mistakes early enough. We cannot totally eliminate it. So here are the numbers. You can see the table from 2005. There is a list of companies which actually even we have seen the capital being eroded. And for some companies, they've been just able to be flat at the levels after 17 years of their existence. Similarly, the other table talks about last 5 years, how has been the performance. So you can see here some of the names have done very well in last 1 year, but despite that, their 5-year returns have been quite poor. So why this typically happens and why process is important is a clear example that we have given here in terms of the narrative. Is that a company which was managing which was making the boiler equipments. This company had a specific advantages of having the best cost curve or ability to produce at the lowest prices when India was putting up power plants of 250 megawatts and below. What happened during that period is that when the power sector was doing well in terms of additional power plants being put up, this company had a phenomenal run of almost 16 times it ran up in the 13 years that after it came into Sensex. Now, this was the period when we couldn't have ignored the competitive advantage that this company had. But, as India moved to supercritical power plants, and also this company had to then import components, their cost advantage was lost. India also went into a surplus situation down the line, and therefore additional order inflow started to affect. And you have seen this company losing 84% of the market cap in the subsequent period to become a mid-cap company. Now, as I said, the process should have identified this, because if for 13 years the company has grown well on the basis of the business fundamentals on their side, we should have taken exposure to this. The process should have pointed out this, as well as the process should have indicated us to come out of the company not at the peak, maybe, because it's hard to kind of time the market, but yes, it is basically somewhere down the line. If the competitive advantages are weakening, our process has indicated that probably here the value destruction might happen, and therefore I think the process is most important. So with this backdrop, I would also like to reiterate our investment philosophy, and which Karthik is he shares the similar philosophy. That is how, as Vetri was mentioning, the process started a year back, and we've had that. We will have about 6 months time together before superannuate. So the basic principles of investment are on twofold: growth at reasonable price. So we are open to look at companies which have probably stable earnings growth, but a long growth runway. So current valuations might look expensive, but as we expect that for the advantages or the franchise that this company has built can enable this company to grow its earning for a long period of time, we would be happy to look at this company. There are examples which I'll come in a while. At the same time, where the companies are, maybe the sector is cyclical, we are looking to look at the companies in these sectors also, because we think that within the sector, these are the companies which have certain competitive advantages, and when the tide turns, these same advantages will make this company to ride, or this business to ride the cycle much better than the competition in the same sector. So typically, when market underestimates the long growth runway, or when the market underestimates the recovery from the lower levels of returns, we are open to look at such companies. In addition, we also look at competitive franchise. That is, what is it that the companies will continue to deliver? What are the advantages versus the competition? Are they durable? Are they sustainable over a long period of time? These are the evidences that typically we look for. What is important for us has been that these advantages should be, first of all, durable, and it should lead to either the pricing power in the B2C businesses or the cost competitiveness in B2B businesses. So I'll come to the specific, advantages that we have listed in the next slide, that you see that what are the sources of advantages. While the tangible ones we can clearly identify, we can quantify them, we can see these in numbers in the disclosures that the company makes, either in terms of the distribution network, the service network, or the cost competitiveness. In case of banks, the source of funds, whether it is low cost of deposits, sourcing and supply chain efficiency, etc. But the tricky ones are intangibles. So, for example, the brand is strong, but if that strength of the brand is not leading ultimately to the pricing power, that strength is probably, it's not the strength, and the brand, however marketing the company may be making, that may not be leading to additional growth. Technology superiority, R&D capability, patents, regulatory approvals are some of the intangibles which are probably the qualitative aspect of analyzing companies in terms of the sustainability of the competitive advantages. Comes more at the level of intangibles, advantages, sources. Next, please. So we thought we'll have a couple of examples to, just make the point as far as the competitive franchise is concerned. So here is a case of a retail bank. Now you can see that for a banking business, what is important is how well they are earning the spread on the on lending, and their source of funds is, of course, the deposits. Now, the spreads can be intact or growing or well protected if your underwriting skills are good, because competition will restrict the level of interest that you can charge. But if your underwriting is good, you will have much lower credit cost than the rest of the competitors. Similarly, if your source of fund is lower, you will have also the advantage of spreads being higher than the bank which has a lower current account and savings account deposits, and therefore little higher cost of funds. So this is the bank. We have taken a period of 23 years here, and you can see that this bank has grown its advances by 37% CAGR. Profits also have grown at 30%. They had a tight control over low cost of funds and superior underwriting skills. Now, this bank, as I was saying, even if you say in 98, 99, this bank would have been quoting at in excess of 3.5 times price to book. Today, even after the current correction in the valuation, this bank has been topping the chart as far as the long-term multi-bagger returns is concerned. So that's the competitive advantages which is more sustainable, and it is needless to say that the advanced growth has translated, or profit growth has more than translated into the return growth for the shareholders. The other example we thought we would give from the B2B sectors. So when it comes to business dealings, the client is also very much competent, and he negotiates hard. So what is important in these businesses is where you are sitting in cost curve. So if you are cost competitive, naturally with the competition to gain orders or to gain client, if the prices are dropped, the company with strong competitive advantage on the cost front would still make the money. And here we look at how efficiently the capacity has been put up, what has been the operational efficiencies. And companies into IT and pharma, what is important is that whether the companies are investing rightly to move up the value chain. So there are some examples which you can see later, what are the parameters that we look at in such B2B sectors, more to do with improving capabilities and staying cost competitive. Next slide, please. Then we also have examples of pricing power in B2C sectors as well as the industry consolidation. Paints, the top three players contribute about more than 70% of the market is controlled by the top players. Here is the example where a leader with more than 50% market share, that leader has demonstrated pricing power. The raw material prices have actually doubled in last 17 to 18 years. In fact, more than double. We have seen the gross margins have expanded. And not only that, the operating leverage benefits or operational efficiencies which come with the volume growth have also shown a much higher EBITDA margin expansion. Telecom is another example where entry of a new player eroded almost 30% of the revenue and profit pool, and the number of players reduced from 10 plus to about 3 plus. And what we expect now, and that is why we have an active weight here. Karthik, I'm sure Karthik will discuss the portfolio and our thoughts at this point of time. But the point is that consolidation can also create opportunities because, as the tariff normalization happens, we could see this industry also coming back on the higher return on capital employed. With this, I would like to hand over to Karthik, and then together we can take the sessions after he discusses the portfolio thoughts and what has been our sector thoughts at this point of time. Thank you. Over to you, Karthik.
Thanks, Swati. Good evening, everyone. Just continuing from where Vetri and Swati left. Vetri has given the longer-term outlook for the economy, and Swati has discussed the portfolio strategy and the construct. I'll come to the actual portfolio itself. If we see the August end holdings, the top 20 holdings on the left-hand side of the table, where you can see almost majority of the active weights are positive. To say that this is more a strong conviction portfolio where we have positive active weights in most of the names. The top 10 names would have close to 47% weight, and the top 20 would have close to 2/3 of the portfolio. And it is across sectors, right from financial services, IT, capital goods, construction, auto, angs, pharma, and consumer as well. If we go to the right-hand side, those are the unique names which are not part of the benchmark. UTI Mastershare is a large cap by SEBI classification. The BSE 100 is our benchmark. The names which are not part of the BSE 100, but we own it in the portfolio, those are the unique stocks which are showcased on the right-hand side table. We have around 14 odd names there representing around 12% weight in the portfolio. These are the so-called mid and small caps, but structural in nature from our point of view. Many of these holdings we've been having in the portfolio for 5, 10, and 15 years. So these are names with high growth or possibly the leaders in their category, and some of the new age businesses as well. So as per the mandate, we have to have at least 80% in large caps, which is around 85% at this point in time. But remaining 15 to 20%, we can identify some of these unique names where we believe there is a potential for higher returns. But these are structural names, not names that we own for just a few months. But like I said, many of them have been there in the portfolio for years together. So where we believe there is long-term compounding opportunities, those are the names we try to identify and put in the portfolio. Niranjan, if we can go to the next slide. Yeah. This shows the key sectors. So financial services, while overall we might be slightly underweight, but within that, the bank lenders is where we are positive on, because the asset quality issues prior to pandemic and the pandemic related asset quality issues, all of them seem to be sorted, and the credit growth has started to pick up and accelerating in a meaningful way. And as far as the valuations are concerned, they're still quite within the average. And the runway for growth for especially some of these banks is very long, with the banking industry itself expected to grow at a fast clip, and some of these banks likely to gain market share like the way they have done in the last 2 decades. So that's where we are very positive on the bank lender space overall. While from a sector perspective, overall BFSI, we are slightly underweight. Coming to the next key sector, IT again, very good cash flows, high return ratios, high earnings visibility, and good corporate governance. And there's a huge opportunity in terms of the cloud and digital transformation, which has kind of got accelerated during the pandemic. However, there are two issues as of now. One, the valuations have significantly moved up in the last couple of years and expensive compared to their own history. And the second one is in the last 6 months, the kind of macro concerns that we are seeing, especially in US and Europe. So that's where we are kind of neutral on IT at this point in time. For the growth it provides, the valuations seem to be a little higher. Coming to consumer goods, while pure FMCG, the growth has been in single digits, but the valuations have inched up over the last many years. To that extent, on FMCG, we are underweight, but the discretionary part, which is the retail and the consumer durables, is where we are quite positive, and there we are overweight. And we believe the per capita income is kind of crossed the $2,000, and we are at an inflection point, and the demographics are in favor. Over the next few years, there is high potential for growth in some of these pockets. Coming to pharma, again, we are overweight on this sector. What we like here is the domestic healthcare infrastructure, and on the pharma side, the chronic portfolio, where we believe the growth is likely to continue to be higher than the overall industry itself, which has been the case in last 8-10 years as well. And on the exports business, again, we are positive on the contract manufacturing and the complex generics and the specialty portfolio as such, where the pricing pressure is far lower compared to the generics. Coming to auto, again, auto has gone through a kind of rough patch in the last 3 years. It's a cyclical in nature, but there's a structural element to this as well. Even in the last webinar, Sachin kind of detailed how the penetration overall in the industry is quite low, and to that extent, there's a long runway for growth in this sector as well. In the last 3 years, we've had headwinds in terms of the pandemic, in terms of the raw material costs going up, the insurance costs increasing, regulatory issues, and even some of the components like semiconductor shortages, all of this impacting the industry. But most of these headwinds seem to be kind of turning around, and the valuations still are reasonable compared to the growth potential. So we are overweight on auto as well. If we go to the next slide, this is again representation of the overall sector positioning. Like I mentioned, auto and consumer discretionary, we are overweight, and within financials, bank lenders, we are overweight. IT, we are marginally underweight, and besides that, the key underweights here are oil and gas, power and metals, where these are more capital intensive and global in nature, and where we believe the valuations have done a little bit of catch up in the last couple of years, but the structural growth is not so attractive. And besides the sectors that I've discussed about, we're positive on telecom and capital goods as well. Swati did touch about the consolidation in the telecom sector, which is likely to help them in terms of the cash flow generation and the balance sheet deleveraging. Capital goods, again, after almost a lull decade, seems to be kind of turning around. So that's how Mastershare is positioned. If we go to the next slide, this shows the long-term wealth creation. UTI Mastershare, as many of you are aware, is the oldest fund, started in '86. If 10 lakh rupees was invested in 1986, today the value of that would be around 18.67 18.67 crore, versus if it was invested in the BSE 100, it would have been around 12.3 odd crores, a difference of close to 6.3 crores. The compounding numbers, the CAGR is around 15.68% for Mastershare versus 14.35 for the BSE 100 total return index. So outperformance of around 1.35%, but when you see over a period of 36 years, almost 6+ crores of additional wealth created. That's the beauty of compounding. So clearly, that's where we believe the long-term horizon clearly helps in kind of wealth creation. I think with that, I'll stop and back to you, Niraj.
Thanks a lot, Karthikraj and Swati ma'am, for a detailed rundown on UTI Mastershare Unit Scheme, India's first diversified equity fund. So while we have received a few questions already, and many questions are already, continues to come our way, and I request the participants to keep posting your questions. We will take as many questions as possible in next 15-20 minutes. And first question for the evening is, and this is a question to Mr. Karthikraj. With big getting bigger, is growth a concern for large cap companies? How about opportunities in emerging sector or businesses?
Yeah, so there are two parts to the question. So the first part, big getting bigger, is size an issue? Should the growth for large companies slow down? The answer is clear, no. Like Swati highlighted in the slides, many of these large companies have compounded even in the last 5 years or even the last 17 odd years time horizon that we've seen. And even going back to Vetri's presentation, even in the next 18-20 years, India is going to be amongst the fastest growing large economies. And to that extent, the runway for growth, even for large companies, is quite high. Within that, again, the large companies still have room to gain from the unorganized sector and can grow through even inorganic routes through acquisitions as well. And many of these sectors still, while they are large caps by market cap, but from a growth perspective, like I mentioned, banking, even in some pockets of consumer, retail, auto, the runway for growth is quite long. And to that extent, don't think that just because they're large companies, the growth is going to be a concern. There is enough room for growth as far as the large companies. So that's the first part. On the second part, on the opportunities in the emerging sectors, like I mentioned in the portfolio slide, there are about 14 odd unique opportunities that we've identified which are outside the benchmark. These are typically the ideas which are, we believe, faster in growth and which are leaders in their sector, even though the sector might be a little smaller, or some of these new age tech businesses. So we are able to capture those opportunities as well in the non-benchmark part of the portfolio, which is around the 15% range that we run. So we are able to kind of capture those emerging opportunities as well.
Thanks, Karthikraj. So the next question is to Vetri. In a tight fiscal situation, how does the production-linked incentive PLI scheme stand out today? Secondly, could there be a challenge of low scale of economics and lack of technology changing the market dynamics?
Yeah, sure. Thanks, Niranjan. So, I think perhaps the question is also coming because today, once again, there has been something about the release of the first amount of money under the PLI scheme. But really, if you look at the announcement, it's nothing new. This is what government had announced about the PLI scheme almost a year ago. So the total budgeted spend is about 2 lakh crores over 5 years, which is 40,000 crores a year. 40,000 crores a year in the government budget, it's not an insignificant number, but it's not a number which breaks the budget. So they certainly have the ability to spend that much. Essentially, this is by way of a capital subsidy. And the reason for the capital subsidy is the second part of the question, because it is a recognition of the fact that in many businesses, there are challenges relating to a lack of scale, and therefore the reason why government is providing this subsidy to these businesses, and it's providing it in an intelligent way. It is linked to the incremental businesses that these companies generate. Therefore, it is giving them an opportunity to gradually build the scale in the business that would allow them to be competitive, and simultaneously also ensures that the subsidy is only paid as the business itself scales up. So I would say the incentive for scaling up is built into that. The challenge is that the norms for value addition are not very clear. It is possible that companies could misuse the lack of value addition being specified in the award process, and therefore benefit disproportionately without high degree of value addition. But it is a risk that the government has taken with the scheme to try and incentivize domestic production. So, I think as of now, it's very early days, and it is a welcome scheme.
Thanks, Vetri. The next question is to Swati. Ma'am, the question is like this. Over the last 1 to 2 years, the return divergence among the large cap funds have been significantly higher. Considering the return divergence, how should a long-term investor construct his or her large cap portfolio?
Yeah, thanks, Niranjan, for this question. But I think it is not that it is only recently that we are seeing the divergence. If you see the top decile and the bottom decile funds, the divergence is always higher. And to that extent, there is a tendency to look at the top performing funds, and we have included this comparison of a strategy which would have followed just the top performing funds. And you see Mastershare for last 15 years has always invested more than 80% in large cap. So consistently, we have looked at large cap as a category as far as this fund is concerned, and we did not change this fund into a large cap category after the categorization. So even by sticking to that large cap mandate, and we just saw that even in Sensex companies, there will be companies which have really given good returns, and there are companies which have actually faltered. So I think it is the numbers suggest, the data suggests here that if one would have invested in Mastershare 10 lakhs, that has generated higher return not only versus the benchmark, but also amongst the peer. So I guess the investment process importance, which we have been highlighting, that there is no star fund manager, but the process is star, is clearly reflected in these numbers that over a long period of time, let's say 5 years and 7 years, we have been able to beat the peers. We have been able to come in that top quartile without actually chasing that top 5 funds, or being in the top 5 on any of the years that we have discussed. So I think this is what is important, and this is what we wanted to emphasize on the process part of it, and the numbers are there to speak. Yeah, so this is another slide which we have been including in the presentation, the product presentation, which talks about why, again, the process is important. Here we have looked at the drawdown whenever the markets have corrected more than 20%. So Mastershare, first of all, the period can be higher. So you can see here that the correction period has ranged anywhere from 35 days to 400 days in past 15 years. And again, the drawdown has been lower as far as the Mastershare's NAV is concerned versus the benchmark. And more importantly, the people who bear that pain and stay invested, they have got the increase in the NAV they have realized after that drawdown. So it only suggests that the markets are non-linear, and one has to be patient. And there is greed and fear is something which we need to control, and do not give up to greed and fear temptations. Rather look at asset allocation. This is the classic example of what goes down has also the capacity to come up. Yeah, back to you, Niranjan.
Yeah, thank you, ma'am. The next question is to Vetri. Actually, the question is on GDP. India's GDP for the Q1 of FY23 rose at 13.5%, slightly below the expected growth of 15 to 16%. However, if the global growth is expected to slow down over the next couple of quarters, what are the factors that could lend support to India's growth outlook?
So good question. First of all, as we have repeatedly pointed out, the first quarter year-on-year comparison is not an accurate indication of the growth trajectory of the economy, because remember, this same quarter last year was the time we were hit by the Delta wave, and as a result of that, activity had come to a standstill. RBI has already got its forecast, which is about 7.2% for the full year. I suspect, given the slight disappointment in the first quarter, they will shape their estimates down maybe by 20-30 basis points. And their forecast, if you look at the quarterly forecast which they have in place for the second, third, and fourth quarter, indicate a year-on-year trajectory of about 4 to 5%. So I think that remains a reasonably conservative estimate in that sense. Yes, if the world goes to pieces, given the troubles in China as well as in Europe, and increasing pressure in the US, where the US Fed in particular is hiking rates to slow down their economy, then there could be some collateral damage in India as well, and some shaving off the GDP growth rates. But I don't think it will be too significant. So, can 7% come down to 6%? Answer is, of course, it's possible. But is 7 going to go to 3% or 4%? I would think that is in the realm of a very, very low probability event at this point of time. I think the quarter-on-quarter momentum that we are seeing in the economy should keep us well on track, at least for a 6% GDP growth outcome. But, all of this is forecasting, and, every number is subject to risk. But our risks are much lower than other parts of the world.
Thanks, Vetri. The next question is to Swati ma'am. Ma'am, this is on the market cap allocation to within the UTI Mastershare Fund. The fund has 13% allocation to mid and small cap. What is your view on this segment of the portfolio on the backdrop of stretched valuation?
So first of all, when we look at the market for valuation guardrail, I think we have to understand that it's a aggregation of many companies, many businesses. Now, when we look at Mastershare, particularly, we have, as I articulated, we're looking for sustainable competitive advantages. And again, when we think that these advantages are likely to help companies to have a steady growth, we have backed those companies. We have taken these companies into our portfolio. For example, whether it was a power exchange or in bearings business, or it was a tire company, we have gone ahead for looked for such advantages, and we have gone ahead. So I guess as long as we stick to our mandate of looking for high ROC businesses, where we think that these are sustainably, these businesses can continue to generate those, as well as have strong evidence of cash flow generation, irrespective of the market cap, will be open to look at these. So I think it is more to do with the bottom-up stock picking as far as the mid-cap and small cap space is concerned. And but we will be open to take it up to the maximum of 20% as per the mandate. I guess it is a case specific, and we should not really look at from a perspective that we will be shifting the market cap based allocation based on the index valuation, rather than it will be a bottom-up kind of stock picking.
Sure, ma'am. Thanks. There is one question on IT sector. So maybe Karthikraj can take this up. This is a question coming from Abhishek Agrawal. So what will be the outlook for IT companies considering the tension or the worries which is prevailing in the US?
Yeah, US is clearly a large market for many of these IT services players. Around 60+% kind of revenues do come from US geography. To that extent, it is very significant. Like I mentioned, the pandemic has kind of preponed the digitization and the cloud business to a great extent, and to that extent, next few years outlook overall for the IT sector looks quite strong. But having said that, the macro concerns of higher interest rates and the possible impact of that on the US economy is something that we need to see in the short term. But it is anyone's guess what happens in the next few quarters. But the medium to long term setup still looks good. These are companies who've been consistently gaining market share in the outsourcing space, and they are quite efficient, generate very good cash flows. So the medium to long term outlook definitely looks good. Just like I mentioned, the valuations had run up compared to their own history, and the near term probably versus expectations, there could be a little bit of toning down, which is difficult to predict, but no issues on the medium to long term horizon.
Thanks, Karthikraj. There is one question on pharma sector. Maybe you can answer this again. This is coming from Mr. Pallav Tiwari. Despite of high growth potential in the ecosystem of pharma sector, YOY growth of the sector continues to be dragged. So what is causing the derating, and what are the pockets of opportunity?
Yeah, so again, pharma, we can divide it into domestic and the export opportunities. So on the domestic, there is the healthcare infrastructure, which is hospitals, diagnostics, and there is the domestic pharma as well. The healthcare infrastructure itself, there is huge potential for growth. And on the domestic pharma side, the chronic piece is something which has been growing at a faster clip than the overall pharma market. And that trend is likely to continue because of the lifestyle diseases, whether it is diabetes, cardio, neuro, and so on. And to that extent, that is another opportunity. And on the export side, again, generics is where the pricing pressure has been. We've seen anywhere between mid to high single-digit pricing erosion in the last many years in the generics business in US. So that has been a little bit of a pressure on growth and profitability for some of these exporters. There, the opportunities looks better in contract manufacturing or the complex and specialty part where pricing is far better. And from the year perspective, still last year FY22 was good, but on a base of favorable base of FY21. And again, for some businesses, the COVID had kind of impacted the base itself. So the COVID or the pandemic itself has caused a lot of noise, and that's where we're seeing yearly numbers on sales or profitability being a little volatile. But the longer term growth story, especially on the domestic side, looks good, and exports, the selective pockets seem to be quite good. So we are positioned on those parts, and we believe that should help us.
Sure, Karthikraj, thank you.
I just add, what to the Karthik's point is that because of the COVID impact in the base, either in terms of, for example, the companies which have a significant business coming out of US generic, for example, the new products introduced in specialty pharma, they couldn't, there was no clinics were not open, and there were lockdowns affected them to kind of ramp up their business there. Whereas in the domestic side, we have seen that the many pharmaceutical companies have benefited out of the COVID business, which probably as we move ahead will actually be the things of past, and we'll have more like-to-like comparison. So the sector which outperformed during the COVID period, as probably it is taking a breather, but as Karthik mentioned, we are positive as far as the long-term potential of the sector. Yeah, over to you.
Sure, ma'am. Sure. Ma'am, there's a question on auto sector as well. Auto sector continues to be one of the overweight position in the portfolio as well. So while there is a gradual improvement in the sector in the last 6 months to 1 year, what are the headwinds that could delay the near-term growth for the sector?
I would say, see, auto sector, apart from the points which we have been discussing about the compulsory insurance, the availability of finance, and the overall cost of ownership going up, and the EV disruption, I would say what could probably the probable risk that we have to look forward is that the volume growth, first of all, while the order books were good for most of the companies and they stopped the taking orders because of the component supply issue, the sector is poised now for the operating leverage benefits to come. So what is important for the sector is the volume growth, and volume growth, we think that long term is a positive, definitely a tailwind for the sector, because take for example cars. We are just 3% penetrated as far as the cars is concerned, and we have an ever aspiring youth which would like to own a vehicle, for example. So the penetration argument is very strong, premiumization argument is very strong. We think that the launch pipeline would also gain momentum with the normalization of economy. So all these factors are pointing towards a healthy volume growth over the next period. But in the short term, I'm saying the headwind could come out of operating leverage not playing out as it is expected by the market. But apart from that, we are positive on the long term. We anyway don't look at the quarterly numbers or what is going to happen in next couple of quarters. But what has been the long-term and story, and which are the businesses or companies which are likely to ride this story. For example, in two-wheelers, we have focused on premium motorbikes rather than the premium and the economy segment of bikes, because we think that is most exposed to the EV risk. So these are some of the things which we are watching out for, Niranjan.
Thanks, ma'am. Participants, due to the paucity of time, so we will take last 2 or 3 questions for the evening. And this is a question to Karthikraj. Karthikraj, this is a question on the Mastershare portfolio. So what is the strategy followed for portfolio churn, and how and when does the stock exit calls are taken in the portfolio? And the another question is, what is the percentage of cash call that the fund take?
Yeah, so answering the first and the third part, the churn generally in the portfolio, as we would say over the long term, has been one of the lowest. So the idea is to have companies from a longer term perspective, and to that extent, the overall churn of the portfolio has been quite low. And on the third part, on the cash call, we generally don't take cash calls, so across funds, the cash has been quite low, and Mastershare is no exception as such. Now coming to when do we exit a company is generally, as we elaborated, we focusing on some of the competitive advantages in the businesses. For any reason, if any of these competitive advantages to be impacted on a permanent basis, that's when really we kind of reevaluate whether it makes sense to kind of continue with the company in the portfolio. Valuations are generally never the starting point or the only reason for getting a stock into the portfolio or exiting. If at all the valuations tend to of companies that we like tend to become expensive, we do kind of prune the exposure, but exiting a company is a lot more on the long-term fundamentals, the growth opportunities, the competitive advantage, the return ratios. Those are the factors we look at, and if there are any permanent damages to any of these versus our expectations, that's when we typically look to kind of exit or take them out of the portfolio.
The last piece is on the cash.
Yeah, cash, like I said, I mean, we don't take cash calls. It's more less minimal at 1 to 5% kind of range.
Yeah, sure. Thanks, Karthikraj. Vetri, there is a question to you. There is a growing interest among investors for smart beta funds, which are passively managed. So what is your view in terms of investors' allocation between active and passive funds? This is a question from Mr. Rajaram Swaminathan.
Yeah, thanks, Niranjan. Maybe that's the last question we'll take and then we'll close it. So, I think what we've always articulated is that there is place in every investor's portfolio for active and passive. It's not or, it is actually both. And it's a question of what really suits your requirements and what you are looking for within that. But, I think that is best for any investor to work with an advisor to determine what is that right ratio that they would like to have. As far as smart beta funds are concerned, it sits somewhere in the intersection of passive and active, because it is not fully passive. It is active in the sense of being driven by one or two variables. And those variables could actually be variables that active fund managers emphasize in their own strategy. So I would say it is, somewhere a subset of both active and passive investing. There is scope for, smart beta, to the extent that smart beta is trying to still generate an alpha for you over the benchmark, whereas by definition a pure passive strategy does not even try to generate alpha. But it must be said that any smart beta strategy, to the extent that it emphasizes a particular variable, it will have its own performance cycle. There will be periods during which it will generate alpha relative to that benchmark, but there will be periods where it generates a underperformance relative to the benchmark. So which is why in that sense it is more comparable to active rather than being a pure passive product. But because of its cost dynamics being what they are, again, the strategy has a certain value for money appeal. It has an appeal that what you buy, what you see as the strategy is what you get. It is not subject to fund manager changes or a change in philosophy, so on and so forth. So I think smart beta will remain at that intersection of those looking for a balance between active and passive. And good advisors will figure out how to use it, particularly, and I'm sure they will do it irrespective of what I say, to be able to time cycles and get the benefit of, positive alpha capture during certain moods of the market. It's always easier said than done, but to those who would like to do it, it creates that opportunity.
Thanks a lot, Vetri, for that clarification. Highly helpful. Just an announcement, participants, please use the feedback link available on the screen to share your feedback on the topics covered today and on the webinar in general. It will help us to do better in our upcoming engagements with you. So with that, I will hand it over back to Vetri. Thanks. Yeah.
Sure. Thank you, Niranjan, as always, for holding up one end of this entire webinar. And thanks to Karthik and Swati for being here on this session with me today. And thank you to all of you for participating in the webinar and sending in your questions. I should just point out in this webinar that, Swati made a point earlier on when she was talking about process, to say the process is the star. That is true. I've always said that, the process is very central to everything that we do, but no process can work if we don't have good people. And Swati's track record at UTI is not just good, it's exceptional. She has a very calm demeanor, but also has a very steely resolve. And it's a attitude which has not only benefited Mastershare and the investors who have been in that strategy for so many years, but it's an influence which has impacted everybody who works with her in that team. And it is something that we will certainly miss when she is not with us. But hopefully the behavior that she has led and demonstrated from the front is something that all of us will continue. And Karthik certainly has a very high ask rate to keep up the track record that Swati has built up. But thanks once again. And I thought I should just put that in perspective. Have a great evening, everybody. Thank you.
Thank you, Vetri. I'll be around for some more time, and I'm sure Karthik comes with a long way to go, and he will cross my record of 16 years with Mastershare. So I'm looking forward for that.
Well said, Swati.
Yes. Thank you. Thank you. Thank you all.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.